thanks for making the effort. I've got Sam Hatcher here, who's from JLL. He does retail. Doesn't know a thing about office, but I thought I'd get him up here anyway. But he is the number one shopping centre salesman in Australasia, and he deals in the capital market. So he's talking with all the buyers and sellers in the bigger end. And Sam is not involved in this transaction, and neither is JLL. So there's nothing in it for him except to see investors make money. So now, can everyone down the back there hear me? Yes. Okay. All right. Well, we'll get into this little beauty. So when we looked at buying this, I just didn't think we'd get it at a price that I thought would be attractive. And I was surprising how quickly they accepted our offer. So it shows we're getting into those times where there's some pretty desperate vendors. And the only thing that I didn't like about it at the time was that Daniel Andrews was the premier, and I said to Adam, that's the only thing I don't like. And the next day he was gone. So I don't know who Adam spoke to overnight, but anyway, we got it sorted. So when we started going through some of the assets we had, and I don't know if you can see it from back there, but the first property we bought in Melbourne was a strata titled gym. So you wouldn't think you'd be doing too well out of that, but over 3 years and 9 months we had a 33% internal rate of return, so that was a nice bit of luck there. We bought another one in 2013 off Centuria. We had that for just 3 years, 8 months, and we got a 47% internal rate of return there, so I know that's tripling our money or something like that. And then we bought another one at Menai. Percy, where are you? So I was told that anyway, we got a 31% internal rate of return over 3 years on that. And then another one at Jimboomba that a mate of mine who knows a lot about retail said it was a terrible buy, and we got a 37.5% internal rate of return on that. So there's about the first 25 we bought. So the average internal rate of return was 24% over 4 years and 8 months. So it's just when we started putting it together, as most of our investors would know, over the last probably 8 years, we've been open-ended funds, because over longer term, I think that's better for everyone. But what it shows, when you buy assets in a down market, which is where we are now, 3 to 5 years you're out of most of these. Now, you can get this just off Danny if you want it, but there's a few in here that we had for 9 years and 8 years. Now, they're assets that we actually end up keeping and selling them into another fund. So if you took those out, we'd be at 25% internal rate of return over about a 4 year period. So I think this asset we're buying, it'll be a trading property. It's not like our industrial 100 acres at Mayfield that you really don't want to sell, and we've got 25 acres at Cleveland we've had for 13 years, and that's a bit over 19% internal rate of return. But in general, when you're buying in a down market, you're out in 3 to 5 years. So I expect that'll be the case with this one. So I think in about 2012 they started a thing called Morgan Stanley Capital Index. Morgan Stanley Capital Index, they have it for different share funds all over the world. Share fund for Asia, they have a MSCI for the listed REITs. And they started one about 2011 for the unlisted funds. And they asked us to join that, which we did, and you'll see, that doesn't show on, bloody thing. Anyway, that we were number one 45 times out of 56 months, so better than most. And so here's some of our properties. So we had Mackay was number one, 16 months, Cleveland number one, 14 months, Rutherford 11 months, Office Trust for 2 months. Anyway, there we go. Now they actually, after MSCI started up, they actually kept changing the rules, because initially it was the best 5 in Australia. We kept winning that, so they got up the top 8. and then they went to the top 10 and we kept winning those. So then they actually changed that if you spent more than 10% of the purchase price of the property in the first 2 years, it was classed as a development, which was just crazy because some of the assets we were buying just hadn't been looked after and you had to spend money, whether it was air conditioning, whatever it was. So they changed that to 20% and we kept winning anyway. So anyway, when you're on top, you know you're best pulling out before, because there's only one way to go. So this is the property we're buying. I think you've probably seen enough info on that, but it had a valuation of 132 million. 30 June 2022 was 111.5 million. 30 June 23, so what's that, 4 months ago or something, and we paid 80. Now, I think both of those valuations were probably wrong, but I think the 80 million is wrong as well. 9.3% in the location of this is mispriced. I think we got some research from Knight Frank a couple of weeks ago from their Melbourne valuation department, and they say that the Melbourne suburban office buildings are still in the 5%. So, that's clearly wrong. But I think at 9.3, this is mispriced. The vendors need the money very quick because they've got some developments that they must complete because they've got heads of agreement with major tenants. They can't borrow any more. You can have a look at their share price. They can't raise equity on the market because their shares are down. And when times are tough, you've got to sell your good properties. You can't sell the bad stuff. So we're the beneficiaries. So it's all pretty simple. I think everyone's read this. It's buying at a high yield. That particular precinct, there was 30,000 square metres leased over the last 3 years. There's only a bit over 2% vacancy in the 2% vacancy in the whole park. So you'd expect that this would be taken up pretty quick. I know one of the things that a lot of people talk about is the work from home. Now, if you read the fin and that, you'll see that is changing. Commonwealth Bank have all of their managers now come into the office 5 days a week, and the next thing will be forcing the rest of the staff. I think Facebook, whatever he calls that, that's the same thing. So they are coming back. The government probably not as much because they're as productive sitting at home doing nothing as they are in the office. So it doesn't make much difference with them. So people, if people are going to work 5 days a week, they learn to take the public transport. But if you're doing 4 days a week or 3 days a week, then people tend to use more, drive their car. So there's one car park per 33 square metres, which is a very high parking ratio. We're close to the freeway, easy access. We've got 5.5 and 5-star neighbours rating, 6-star water. So I think when you go through the matrix to tick all the boxes, I think it does tick all the boxes. We're about 35% below replacement costs, and I think we're seeing that across all sectors. In the Financial Review today had the article on shopping centres. You just can't afford to build assets. It's just whether it's industrial, residential. So if you've got good quality assets, well priced, there should be some really good rental growth in the next couple of years. I think everyone would have read that, so I won't waste your time. You can see the office park. It's in a very good precinct. There's a university at the back. There's 3 train stations within a kilometre. You've got a tram stop out the front. There's actually a hotel in the. This is a hotel here. So it's got everything you want. I think you've probably read all this as well. It was all sent out. It's easy access to the freeway. It's close to the MCG. It's not far from the city, so if you're working then you've got to slip into the city. The rents are competitive. It's a couple $100 a metre under what your most relevant competition would be. The car parks are a couple $100 a month less, so there's no reason why this won't lease up very quickly. There's actually a 700 metre tenant now that's we're doing a lease on. So I just spoke about this with the rents, and if you buy, so if you build something new, the second bullet point there, you're $750 to $850 a metre. So it's they won't be building anything in the immediate future. They say Melbourne's the most popular city in Australia. I don't want to be having an argument over Sydney, but whatever it is. And one thing that really surprised me, this came out yesterday, that Victoria's the top economy in Australia. I think the last survey was number 5. So, a simple act of Dan Andrews going has turned the state around enormously. So, that's independent, and it's I think, as all of us know, they got really hammered during COVID, and they've come back strong. I would have thought that in 3 to 5 years we're out of this very easy. So this has just got a chart on the yield. So this is this is from your company, Sam, JLL. So you can see we're way above where they say the market is now. I think that there hasn't been a lot of transactions, so hence you're seeing the yields down lower. That would change, but I think at 9.3, and I'll let Sam say a couple things soon. I think it is terribly mispriced, but that's the sort of deals you want to be doing. These are just some of the other properties that would be classed as competition. To say, get a copy of this off Danny. There's not much around, and what there is doesn't have the same car parking ratio as we do, and the rent is a bit higher. So that for those who are tossing up whether they should be in the stock market or in property, I got this off Alan Cole, and we're catching up with Alan tomorrow. But it shows that the stock market is a bit below where it was 23 years ago. So you haven't lost too much money. This is just some of the press that came out. Garda's a listed company, listed REIT, and they didn't want us to talk about the property because it is a bit embarrassing, given you'd only had it valued in 30 June at 111.5, and we'd done a deal in sort of 3 months later. Anyway, that's life in the big city. So, and timing is the key. There's no secret to that, whether it's shares or property. And we see these sort of cycles about every decade, and I think most of these people, except for Justin, are over 30. So, you see the cycles come around. What people forget about cycles is that they actually go in cycles. So, the people that were buying in the 3s and 4% and thought you keep going, it just had to turn. No surprise. And it's fantastic. Love to see it. I'll just hand it over to Sam. So, Sam, you just say whatever you like, but I suppose for the investors here, it's where do you see the cycle, and is it the time to buy?
Thanks, Warren. I think that's an excellent summary of the asset. From a market perspective, and probably just to give a little bit of background on myself, I live in Sydney now, and probably will for the near term, but I started my career in Brisbane at JLL, so I've been at JLL since 2005, and fortunately the first meeting I ever went to was with Warren Abbott, and I learned a lot from him. But I've always been very intrigued by the Sentinel approach in the asset classes that they've invested in over long periods of time, because they're sector agnostic and they're very deal specific focused. They don't chase a market alongside the institutions. They're like the salmon swimming upstream. And I think your early deals, Warren, were largely industrial in circa sort of 2010. I know I wanted industrial then. Over my career, I've always been in retail sales, so I'm not an office expert, I'm not an industrial expert, but I watched what Warren was doing with industrial properties then, and they ran yields from 10 and 11% into 5.5%, 4%. Large land holdings have been able to repatriate initial equity back, and in addition to having investors continue to collect the upside. And there's probably very few managers in the country that I've witnessed that have a track record of doing as many deals as Warren has done. And you look at the track record earlier, like there's a number of syndicators and smart investors around that might do 4 or 5 deals, and they might get a 22% IRR or a 30% IRR on a handful of deals. But to do that amount of deals and have that average IRR, in my 17 years in agency, I'm yet to see another manager that has the same track record. And I've had a tough time in shopping centre world because no one's wanted to own them over the last 7 years. And if you think about asset classes institutionalising, I mean, institutions will come in once all the deals have been done and the data's there, and that's when the super fund money starts to come in, and the super fund money ran the industrial market and continues to run. And there are some clever markets and deals around in industrial, but when you're buying at sort of 4%, it's hard to make everything work because your pricing from 4 to 5% is actually, if yields soften by 100 basis points, that's 20%, 22% of asset value. You know, a 9 to 10% is about 8% of asset value. And in retail, we've seen, a significant part of the asset class uninstitutionalised. So the syndicators have come in and absorbed a lot of the stock. So I've been involved in a lot of deals with syndicators that have been acquiring large shopping centres. I sold Casuarina Square most recently and Canelands shopping centres in Darwin and Mackay to Sentinel. And we're probably just on the precipice now of institutional capital starting to re-enter shopping centre world. Does that mean they're coming in droves? No, but on an average basis, we get, if I'm up in Singapore over the last 5 to 7 years, I might get 5 to 7 meetings. I was up there a month ago and we had 32 meetings over the course of a week, and that is a lot of offshore capital wanting to re-educate itself on a market that has really sat idle for a long period of time. So the capital is starting to flow back into the retail market. And if you look at what's playing out in the office market now, you're seeing a lot of institutional capital that doesn't know how to price office buildings. So they're happy to sit on the sidelines for 3 or 4 years until they can determine and work out how to price them. But we all know the time to buy is when the institutions and the REITs are running out. And I think that an asset like this, as I said, I'm not an office person, but I do turn up to work every day. And I know that from working in office buildings that the percentage of people coming back to work is significantly increasing and improving. And I think there is a very clever window to be back out buying office buildings. Does that mean you buy every office building that is on the market? Absolutely not. But when you look at the metrics up there, when you're buying something at 9.5%, I look at the rate per square metre of building and replacement costs, but something that I picked up that I wasn't actually aware of was the 400 car bays that come with it. That's not factored into a replacement cost when your valuers are doing their replacement costs, but to actually have 400 cars, it's a lot easier to lease office buildings when you've got 400 cars in addition to being on the train station. So in summary, I'm not here to talk about this particular deal, but as a market sense, we're always seeing asset classes in the real estate sector institutionalise and uninstitutionalise, and you're starting to see the uninstitutionalisation for a period of office buildings, and we're now starting to see the reinstitutionalise of shopping centres and retail, which will drive pricing down. And probably one data point that I wanted to touch on is around the domestic super funds. If the domestic super funds continue their same allocation to real estate, which it averages somewhere between 8 and 9%, on a blended basis across them all. That's $168 billion over the next 5 years that needs to be allocated from super funds into real estate. Now, does that mean that all of that will be spent onshore in Australia? Well, no. Some of it is going offshore, but the track record of domestic super funds offshore hasn't been very strong. So a large percentage of that will come back into the market once they have more conviction around pricing. And it happens every cycle. I definitely haven't been around for as many cycles as what most of the people have in the room, but I was fortunate to start my career early. I was 19 at JLL, so I was fortunate to see the run up into the GFC. My first day as an agent was in 2008, which was a pretty hard time to sell property. So I've seen a bit, but probably not as much as everyone in the room. But I think Warren touched on earlier, everything does happen in cycles, and I think the timing of this opportunity is excellent. But I don't have much more to say other than that.
Are there any questions?
I'm happy to answer any questions as well, preferably on retail.
Question to Tim Kent in relationship to interest rates.
What's the question?
Where are we going with interest rates?
Where are they going? Well, I think the market's pricing in at least one more interest rate rise. Whether that's in a couple of weeks or the following month. Yeah, a week, there you go, that's spot on. So that's what the market's pricing in. Now at the moment, the educated money or the advice from the various banks is one more rise plus that holding on then till about June, mentally dropping from there. So look, from our perspective, we are very much in touch with all the advice and the recommendations in the market from the banks, and that's how we're pricing our interest rates, and we also factor in contingencies in our assets to be able to deal with those sort of events and increases as they come. Is that? No? Yep.
So, what's your general impression of the current proposition that Warren is putting to us in Botanicca? What's your view on that?
Well, give us your overview.
Well, we all work together on these things, and we are at one on that. So at the end of the day, well, I think that what's interesting in the market though is that we've been watching offers for the last 12 months. Now there's been deals, many deals, and you can buy many assets in the market nationally for 7.5% to 8%. You can take your pick at the moment. This is the only one that we've seen at these metrics. I think well, certainly for my end anyway, nationally in the office market, and that's why we've retained an interest in it. You've got a brand new build, well, 2019 build. You've got the car parking. You've got a hedge against new stock with the rent in a city fringe location with a 2.5% vacancy rate. So, look, from our perspective, as I say, we see pretty much all the stock that's available in the market, both on and off the market. Most vendors at the moment are slow to move their book values down. This one is the right money, and that's why we've leapt on it. We haven't bought anything since December, and this is why this is one that we're looking at. Question? Sorry? Oh, sorry.
More are you looking to raise for investors? How much are you looking
The total raise for this one is 52 million, I think.
You haven't settled on this property yet, but you're talking about doing leasing deals. So can you do that before selling it?
In terms of leasing deals, so we have 750 square metres, which is one of the vacancies in our building, which we've got the rental guarantee on. We have a lease deal now till 2030, which has been undertaken now. So that's been done by the vendor, but with our approval. Yeah.
Andrew?
Can I clarify the vacancy in the two buildings?
Yep.
Because the town hall bulletin said one of the buildings was only 73 occupied, but I'm hearing different numbers.
There's 750 square metres and another 1,500 is the two areas that are vacant at the moment. We've got a heads of agreement on the 750, and that's both in building 9. So we've got a rental guarantee on both of those, but one of those we've got a heads of agreement until 2030, which we're finalising. That's with an existing tenant. So we've got a level of comfort on that will move through.